Market snapped its two-week gaining streak to end the week in the red. Financials and FMCG were some of the biggest laggards that we saw today. 34 out of the 50 stocks gave negative returns for the week. Hello and welcome to a fresh new edition of Taking Stock, with a show where we review the week gone by, but more importantly, try and prepare you for the week in front of us. I'm Prashant. With me over the next 30 minutes, my colleague Sonia Shenoy. Hi, Sonia.
Hi, Prashant. It was a rather range-bound week, right? And nothing sort of a week for the market. We still had a lot of headwinds to deal with, whether it was higher crude prices, inflation, the Fed statements about a 50 basis points rate hike. So lots to digest. But let's tell you what we have lined up on the show for you to discuss the technicals for the week. To come, we have Jay Bala of CashTheChaos.com. For the fundamentals, we're joined by Pramod Gubbi of Marcellus Investment. We'll also bring you market opinion that we got through the week from the likes of Dan Feynman of Credit Suisse, Sean Darby of Jefferies, Andrew Holland of Avendus Alternate Strategies. But before that, here's how the markets fared this week. It was a rather range-bound week, as I said. Not too much took place. The Nifty, although held on to the 200-day moving average, it was down about 0.7% this week. The mid-caps did a better showing, so up about 1% or so. The Fmcg stocks, the consumption basket, was under a lot of pressure. Nigel will talk more about that. But the stocks fell anywhere between 5 to 7%. And on the upside, the Reliance batted for the bulls today. So that was in the green. And you had a lot of non-index large caps, this reopening theme. So something like a PVR did well, mid-cap IT did well. So all in all, you'd have to say that it was a pretty range-bound week. But Nigel is here to take us through the specific action on stocks. Nigel, who were the movers and shakers this week?
Well, it was that sort of a week where the Nifty, well, it went in a broad range and in fact ended with a cut of only around 1%. The problem pocket in the past week was the Nifty Bank, that was relative underperformer. But from the broader markets, whether it was the mid or the small cap indices, there was a relative outperformance that comes in there. Metal stocks, they did do well, but that hurts auto companies because they are buying some of those aluminum, steel, and other metals as well. In terms of the Nifty, well, there were a few gainers, though. Big boy, Reliance Industries, that was the heavyweight that did pretty well. That was up close around 4.5%. Coal India as well continued to do well. And metal names, obviously, they did pretty well. Hindalco and JSW Steel were among the winners list. Dr. Reddy's as well, that was a relative outperformer coming in from the pharma pack, because that was up close around 7.5% odd. But consumption-related stocks, they got hit hard, whether it was Britannia, HUL, Titan. Titan, the problem is that some of those brokerages are now saying that valuation-wise, the stock is pretty expensive. But otherwise, consumption stocks like Nestle as well was under some pressure. Kotak Mahindra Bank, you had a large fund in there that went ahead and sold some part of their holding, and that's why that stock was down 5.5%. Broader markets, though, there were a few winners. You had L&T Holding, the promoter, going in there, buying more than 4 crore shares in the past week. So that was a big gainer. Z, because Invesco, they say that they were happy now with the merger with Sony, and they're happy to see that go through. So that was a bit of a relief out there. Concord, towards the end of the week, did pretty well. And Oro Pharma and Delta as well, both of them were spiking up in trade. But the problem is in the broader markets, well, though we had a relative outperformance, you had a few stocks that are under pressure. Consumption names, yet again, Dabur and Godrej Consumer, both of them are under some pressure. Marico as well did see some selling. And JK Cement as well has seen a fair bit of a correction from the time they announced that foray into the paints division. Well, to sum things up, Nifty under some pressure. The Nifty Bank was a problem pocket. Broader markets, there were some gainers, as I just told you. Back to you guys.
Nigel, thanks very much. Comprehensive wrap out. Just a couple of points before we get in. Jay Bala, who's ready with us. So, sixth day, this has been the sixth day that the market, the Nifty that is, has been at, slightly above or under, but around the 61.8% retracement of the January highs to the March fall. If you talk to traders, and this is not just this week, but 2 weeks in a row, I mean, it's been very, very tough. Just take Friday's example, right? For bulk of the day, it did not very much. It was lower by about 50, 60, 70 points. And then in the last 10 minutes, I mean, things sharply went up, not just on the Nifty, but the Bank Nifty. And we've seen multiple instances of this. Global market picture remains unconvincing. Bond markets are doing their thing. There's commodities which are in the mix. And there is, of course, the equity market price action. So it's a flux right now. One thing is clear, cost push inflation is, I think, coming up very clearly from companies we speak with across sectors, be it auto, real estate, infrastructure, consumer durables. All of them are telling us that it's going to hurt margins. And commodities themselves, which is oil and industrial commodities, the price action may look a little toppish, but does it necessarily indicate that a peak is near? perhaps no. I'm talking about oil, I'm talking about base metals, etc. as well. So we are somewhere kind of treading water with no clear answers at this point in time. Let's get to the price action first up. Jay Bala is with cashthechaos.com. He's joining us. Jay has got it right. I mean, he's called this correction, this big correction, right. And last time we spoke, he was basically saying that there is perhaps a little more downside to be done. Jay, thanks for joining in. You're saying that this bounce that we got from the 15,700 kind of levels perhaps is not complete. Could you explain that? Which basically means that you're expecting more on the upside.
Yeah, that's right. That's what I said last week, Prashant. Thanks for having me on the show. I had projected a corrective bounce to somewhere close to 17,700 and plus. But given the price action of this week, I'm starting to get doubts that there's an alternate pattern that's got potential that may play out. But I'm leaning towards the probability that this bounce from 15,700 odds, those levels, is not complete. But there are a couple of things within local factors and international factors. The heavies like autos, banks, and a few pockets in IT are starting to look skittish. And the US S&P has come to very significant resistance levels, somewhere close to 45.20 and 45.90. This is also I projected last week. So given that the markets are coming under important resistance levels, and as you pointed out earlier, the 61.8 Fibonacci retracement level, that is also putting a little bit of pressure on the market. But I'm still slightly leaning towards a little more incomplete move that pushes the market higher, and then the market turns lower for the larger degree turn. I know this correction for the bull market that started from 7,500 and to 18,600. This correction, to me, it looks incomplete. So I'm expecting the next leg of the correction to start once this down move, this corrective bounce plays out.
Oh, okay. So you're saying that the correction is not over just yet. There could be more on the downside for this market. I think we're seeing it in individual stocks as well, right? I mean, in this week gone by, the FMCG stock, the consumption basket, came under so much pressure. Britannia, HUL, Nestle were all down 5 to 7%. Do you think there could be some more pressure there, Jay? And which are the other pockets that you think could lead on the way down?
Yeah, 2 weeks back I said the FMCG stocks are seeing a corrective bounce, and I said don't play this beyond 2 to 5 days time frame, and that's exactly what has happened. It started to cave in under further pressure now, and the key for me is the auto sector. I pointed out in my last interaction that the March lows looks like an incomplete down move, so that has started to cave in. Almost all frontline auto names are starting to look negative at this point of time, and they are likely to test the March lows, and the index is about to about 99,200 on the Nifty Auto Index. And even banks, that's also starting to turn down from 37,000 resistance, and the private sector banks in particular are starting to look weak. And although SBI is looking relatively stable, it's also facing resistance under 520.
Things are looking more down than up overall. You've got two specific positional trades you want to talk about, Jay?
Yeah, that's right, Prashant. As I said, now autos is the key for me, and so I'm picking stocks from two stocks from that sector. Apollo Tires is looking like it's going to go down to about 160. So I'll place a stop at about 200 and go short for a price objective close to about 160. Now Maruti, the frontline name for the auto space, that's also looking like it's done a corrective bounce, and 79.40 is an important resistance for it. I think that's unlikely to get taken out, and the March low is I'm anticipating Maruti and M&M to lead lower. They are relatively weaker stocks within the auto space, so I expect Maruti to break about 6,500 and head close to about 65.93 to be more precise. So two shots on from the auto space.
Okay, any places to hide if this market falls further? Any safe harbors?
Other than cash, I would say Power Grid is surprisingly showing relative strength, and I pointed out in December to hold on to aluminum plays, and also 3 weeks back I said Coal India is a good play. So those are also coming to an end, but don't put incremental money there. Just treat them as trading plays, And I know if you probably you can look at something like precious metals for the medium term, even that will see the short-term headwinds. But if you can stomach the short-term headwinds, you can probably put in some money in the precious metals market.
Okay, thanks a lot, Jay, for joining us. Have a great weekend. It's time for us to head into a short break. On the other side, we have Pramod Gubbi, the co-founder of Marcellus Investment Managers, talking about the fundamentals of the market and all the risks that this market has on its hand. But before that, we leave you with some market opinion that we got through the course of the week.
One of the problems for India right now is that it's trading at a very big premium to the rest of Asia. India is always an expensive market on a PE basis relative to other Asian markets, but right now the premium is close to an all-time high.
Within EM, there has been actually a decent type of switching now between EM bonds into EM equities, and that's not too surprising given some of the rate moves that we're seeing throughout EM. Even in Taiwan, they raised rates last week.
Since October of last year, the Nifty's done, what, zero? I don't think we've moved. But there's a lot of pain in between that, right, with certain stocks or sectors, which is still playing out. So I'm not saying that I think the index is probably the wrong indicator, because, you will have, certain sectors and companies which do well, despite what's happening in the world.
Welcome back to Taking Stock on CNBC-TV18. Well, the rise in input costs has impacted companies across sectors because of what's happening with the Russia-Ukraine crisis. Mangalam Malu is here with a quick wrap on all of that. Mangalam.
Well, a cross-section of India Inc. is definitely worried about input cost inflation. In fact, this week itself, we spoke with, companies like Adani Wilmar, there was JK Cements, IRB Infra. Why just that? We also had Maruti, Bajaj Electricals. So from be it auto, consumer durables, or even consumer staples, or building products, everyone is facing the heat right now. For instance, we had Adani Wilmar, and they said that they've seen a steep cost rise across all areas of business, and sunflower oil consumption itself has dipped by 50% owing to the cost increase that the companies have passed on to the consumer. JK Cement too has said it's been an increase of over 70% in input costs, whereas IRB Infra is pricing in a tariff hike of almost 14 to 15% next year owing to input costs and higher inflation. Brigade too has said that steel prices have doubled in the last 1 year, and prices of cement as well as raw materials like copper, etc. have gone up too, which means that real estate prices will have to go higher as well. Maruti has taken a price hike of 9% this year so far, and the management joined us to say that, even this 9% price hike does not cover for the input cost inflation that they've seen. And finally, we had Bajaj Electricals. When they renewed their contract with Murphy Richards, they said to CNBC-TV18 that the increase in aluminum as well as steel prices have definitely been hurting the company.
Okay, thanks a lot, Mangalam, for that. So let's take the discussion forward. Pramod Gubbi, the co-founder of Marcellus Investment Managers, joins in. Pramod, hi. Thanks for joining us. Now what's happening is people are separating the wheat from the chaff, right? The men from the boys, so to speak, because this raw material cost pressure is going to hit a lot of businesses. But then there are market leaders that pass it on quite well, whether it's something like an Asian Paints or even some of the metal companies. So who do you think the survivors will be from this lot, and how do investors approach it?
Hi, Sonia. Good to be back on the show. You hit the nail on the head. I think the only way to handle inflation as a driver or a headwind against you is get yourself positioned in companies with strong pricing power. Because eventually these companies will be able to pass on the prices. I don't think the passing on of prices will be instantaneous. There will be a couple of quarters of margin hits, given the nature of the customer base and the lag in these price hikes. But the good bit is that inflation affects the weaker players in the industry far greater, and several of them won't have the cushion to even take those couple of quarters of margin pressures, and therefore almost every such high price scenario results in consolidation in the industry. So at the end of the day, not only do you recover margins as the market leader, you also end up with a higher market share. So therefore, I think inflation is here to stay. I don't think it's going away anywhere. I don't think the central banks globally will also dare to hike rates to the extent that they will dampen inflation, partly because many of those governments don't have the ability to service higher debt costs. So if the base case situation is that inflation is here to stay, I think you better be positioned in companies which have sustainable competitive advantages, which have strong balance sheets to withstand these headwinds in the short term, and eventually be able to pass on those prices. Therefore, you get the long-term benefit of both market share gains as well as reasonably high margins.
Pramod, but even within the strong companies, are we in for a period of perhaps, a poor performance? I'm not saying very large corrections or anything, but no great performance on the upside, because it'll hurt them less. But I mean, it's not positive. It'll hurt companies to different degrees. The stronger ones get hurt less. What's your sense?
No, absolutely. I don't think anybody is immune to stock price action in the short run. Given that in the short run, perhaps sentiments override rational fundamentals. To that extent, there will be sell-off in certain sectors across the board, irrespective of how well positioned you are on the fundamental side. And like I said, it's not like they're going to pass on prices immediately either. There will be fundamental impact in the short term as well. So you will see a couple of quarters where margins will compress. But that's the opportunity, really, especially if you're a long-term investor. You wait for such opportunities where high-quality franchises tend to get beaten up, totally out of whack with their fundamentals, and you capitalize on those opportunities, given that in the long run, none of us know how long this will last, but eventually we've seen most of those crises end. And if you're a long-term investor with a 3, 5, perhaps longer-term horizon, these are the best times where you can pick up these stocks, capitalize on those corrections. Yes, you're absolutely right. It's inevitable that even the best of stocks will go through this weak period. And I think the best thing is to watch out and pick them up at these attractive prices.
Absolutely. Just case in point, right? This was a week when the market did nothing, but look at individual stocks. Tata Elxsi, for example, was up 10% in trade on Friday and has now hit a fresh all-time high. So the market is using this time as an opportunity to buy into the stocks that they didn't get a chance to buy perhaps in the last rally. Talking about Tata Elxsi and mid-cap IT, is that a space that you'd bet on?
Yeah, Tata Elxsi especially is a very niche company. We own in that space L&T Technology Services, which is pretty much niche. Unlike mid-cap IT in general, they're not exposed to the IT spends. They're focused on engineering, R&D outsourcing services, which is a very, very niche space. There are hardly a handful of companies in the listed space in that domain. Both Tata Elxsi and L&T Technology Services have significant competitive advantages. And if we look at the demand situation, I'm not a geopolitical expert, but everything that I've heard over the last few weeks is that we're going to see significant reindustrialization in the West, given that the West has seen the sort of effects of depending on a global supply chain far too much, not just the last few weeks, but also the last couple of years. If that is the case, there's going to be significant demand for engineering spends in the West. And given that there are significant labor shortages, particularly skilled labor shortages at the prices that the West have, you might see increased growth opportunities for engineering R&D outsourcing. So to that extent, Tata Elxsi and L&T Technology Services will be winners from a demand perspective. Of course, the challenge here still remains the supply side. The supply side, there's huge shortage for talented engineers, skilled engineers in that domain. Remember, this is just beyond IT services. So therefore, there's an even smaller skill set. But having said that, I think both these companies have built enough of a talent pool to be able to cater to that growing demand. And hopefully, the sort of recent weakness we've seen in the startup scenario could mean that there could be some sort of dampening in terms of demand for talent and therefore wage increases, which has been pretty much of a headwind, both for specialist services companies like these as well as IT services. That should abate, and which should mean that it should augur well for margins as well. So the demand situation seems pretty strong. Hopefully the supply situation sorts itself out in the short run.
All right, Pramod, it's a pleasure. Thank you very much for joining us here on this edition of Taking Stock. Always appreciate your views here on CNBC TV18. Well, that gets us to a close here on this edition of Taking Stock. From Sonia, me, everyone on the team, it's goodbye. Thanks very much for staying with us. More comes up in just a bit.